Let's talk about banks in a bit more detail, Mr. Agrawal. I know you've got a strong view there. So, the general sort of fear has been that deposit rates will rise a lot faster if inflation remains sticky, and the pass-through won't happen through lending rate hikes. But the counter to that is that the growth in lending rates, anyways, is so much more higher. Credit growth is at about 20% or so. Deposit growth is, I think, 15%. So, to start with, there is a large difference. Even if there is, an increase in deposit rates by 100 basis points or 150 basis points, and there is not full pass-through, what's the impact to profitability? Is my question.
Yeah, I think you'll get to see in this quarter, but my sense is that it is still a lender's market. Economy is doing very well. There is very good credit demand. So bankers well-managed banks will be able to broadly pass on the cost increases, or at least they'll be able to contain the overall cost, including the credit cost. And then you have the 15 to 20% kind of volume growth. So the volume growth combined with your improvement in the recovery, I think you should be able to get your whatever ROTA you are expecting, say 100 bips or 110 bips. That should not be that difficult on a larger base. So bankers have a lot of levers. It's not about only deposit rate, because they have within the deposits also they have mix between CASA and term deposit. They have all the assets are most of the assets are not term assets. They're more kind of floating cash credit kind of thing, and then they have short term kind of loans also. So there they have a pricing power also, which can be overnight. So deposits don't get priced all of it suddenly, whereas the assets, bulk of it can be priced. So I think the bankers play with a good technology. They know exactly where to collect more, where they have to pay more, and so I think if you look at the overall last 5-6 years of banks' performance, the volatility in the banks' own profit and loss is not as much as the stock price movements. Markets have its own tendency to look at this names, change in the names, rising interest rate, falling interest rate, bond prices, 10-year yield. So for all kinds of reasons, bank stocks going up and down. But if you look at overall bank profitability, I don't think there is so much of volatility.
Okay, all right. Are you a buyer of bank stocks? And let me sort of focus that question to one stock, Central Bank of India. We spoke about that a couple of months back on a show. I remember you telling me you bought it at close to 100 odd rupees or so. Stock went up to 250, back to 160.
Yeah, so it has come below our buying price, but neither I'm buying. I don't have any money to buy any more any stock, but I'll be very happy if I get money to buy into banking stocks. I think this is much more opportune time to buy banking stocks. The issue is that the prospect for banks, as an investor, don't get changed just because there is some deposit slowdown or government or monetary authorities have some kind of compulsion to slow down credit growth or constrain the liquidity for inflation management or whatever. This is part of the management of the economy. But banks' life is much longer. Their profitability structure. Government is also interested in seeing that banks remain very healthy in terms of even bottom lines. So my sense is that any given opportunity where you get 20-30% discount to whatever is your assessment of the underlying value, you should be buying. These are opportune time. Maybe the banks might go down even further, and you should start buying, and maybe on an average you might get some reasonable price.